Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
Monday morning, welcome back for another weekly market recap. A little bit of a strange day these days. I went out of home on Friday morning. Eventually, I didn't come back up until now. So I actually missed the NFP data point release. And furthermore, I'm gonna head out home again after lunch. Today, so Sunday. I'm probably not going to be back home up until Monday afternoon. So I just wanted to take these, maybe 2 hours to put together a little bit of a video as for the recap and not taking the chance of skipping it. Now, the title and probably the thumbnail at this point would be a bit a bit fishy because I'm not going to talk, of course, about what went on in between Elon Musk and President Trump. First of all, it's not my role. I'm not a political analyst. All I can give is my uh, opinion as an individual. And, to cut a long story short, I think, nobody really gains something from this kind of debacle, especially when it goes public like that through social media and whatnot. Now, don't get me wrong. It's just the times we live in now. Everything has to be done publicly or on the social media, so you got the maximum attention possible. It's just, to me, regardless who you stand for, you could like Trump, you could like Elon, you could think, in these specific argument, one has a point over the other. I don't really care. I just think, at the end of it, it could have been managed a hell of a lot better. Like, you can have a disagreement, you can have an argument, if you want, you can have a fight, like a physical fight. Just, do it behind closed doors. There is a lot of shit that our dear politicians and governors do behind closed doors. So why not keeping this one that way too? Because when you think about it, right, both have something to lose. Of course, Trump has the political capital to lose, since, at the end of it, whatever you think, it doesn't matter what you think about Elon, he got a good amount of influence and he got money, some might say uh, charm. I don't know if I would agree on that. But anyway, he got a huge group of followers and haters too. Same as Trump. They are very polarizing personalities. And and on the other side, Elon, what could he lose in this sort of battle? Well, as Trump stated, uh, govern contracts. I guess could have been run way better, and I'll just leave it at that. I think if one thing, I think one thing which was particularly logical and well thought out in my view. No, it doesn't mean that I cheer up more from one or the other, but I think it's just a fact. When Elon said, Trump is going to be around for another 3 years and a half, I'm going to be here for the next 2 or 3 decades, and I got time. That's just a fact, right? He got the money, he got the power, he got the influence, and he got time, most importantly. And we've seen that when he really wants, whether you think it's right or wrong, but if in his mind, if in his view, that there is something which is right and he wants to stand for it, he got the ability to do that. For how long? We don't know. But, I'm just remembering when he went public on that famous and viral interview when he said something along the lines of, do you think you can blackmail with money? Fuck you. And there was all the drama about advertisers leaving Twitter or X, whatever. So, it's I guess even for President Trump, he could be a tough contender in a fight, whether it's physical, mediatic, or whatnot. We'll see how it goes on. I don't really care at the end of it. I'm just eating popcorns and looking at it because it makes me laugh a lot. Although I do realize, there's nothing to laugh at. You wouldn't expect these type of a child plays coming from, two very important personalities, right? Especially when they are supposed to run a country and not like a banana republic. We are talking the US. I don't know. I laughed because that's kind of my mantra, right? If you don't know how to laugh, you're gonna end up crying. It's sad when you really think about it. But enough of that. Let's jump straight into the charts and let's get rid of the first um, tranche of charts for the day. And let's start out with the DXY. Don't worry, I'm gonna get back to the data, the economic calendar, and whatnot, but later on. I just want to get rid of these first set of charts. So the DXY kept on plunging. Well, I mean, not plunging, but kept on drifting, all right, to the downside, revisiting or retesting around those lows. Up until the point it got a little bit of a reaction on Friday, case in point with NFP. And again, we're going to talk about the reaction the market had to NFP when we look at the equity market. Or, I mean, it kind of goes hand in hand with what happens to Bitcoin or with gold or with rates, but it's all tied up together, you'd see. So I think, at the end of it, nothing really changes for me as for the DXY. I'm still thinking, up until the point these lows can hold. At the very least, we might have a very choppy DXY in the coming days and maybe weeks. I still think, sometimes I look at the positioning. I think, we are getting into very oversold conditions. There is a good amount of positioning to the downside, and the sentiment is really negative, right? Have been negative since when we got the thing about the deficit, the failed auction, supposedly the 20 years, right? So I wouldn't be surprised if eventually we go, and again, I'm going to be redundant with the terminology here, but a surprise to the upside. Maybe not huge, but, a bit of a spike nonetheless. Uh, at the end of it, the dollar, at least, the dollar against that of fiat, it's just a reflection of how different actors around the globe are choosing to store the reserves. So if the dollar is weakening, people start to pull out capital from the US and they get it back home in their local denomination because there is no more benefit in storing their capital here, since they're now losing in the FX exchange value, or maybe there are other political risks or geopolitical risks or other types of assessments, so they just get capital back. Um, as I said in the past, it could be tied to the performances of the stock market. And people say, if you go on Investopedia, for instance, everyone is always revolving around the interest rates differential. Okay, so just, to prove a point, I'm not saying interest rates differential doesn't play a role overall over a long enough period of time, right? I'm just saying, again, if you chart the 10-year yield against the DXY right now, I mean, you see that kind of starting back at the beginning of April, the 10-year yield actually started to go to the upside, and the DXY kept falling. So, if you really bet all your money on the interest rates differential, if yields are going up, and you need to remember again that the XY is heavily weighted against the euro and the yen, and you see that the ECB it, it just cutting rates every single meeting. They go up to the eighth consecutive cut. So interest rates in Europe, as for the ECB, are at 2% now, basically. While on the 10-year Treasury, you can still get an above 4% at this moment, 4.5%. So why wouldn't you expect people to pool money into the US dollar to get a much better yield compared to what they could get if they keep the money into the euro denomination, right? And yet you don't see it happening. Now it does look, it does happen, right? You can see in here yields go up, the XY go up, yields go down, the XY goes down. So it's not to say that this relationship doesn't exist if you zoom out on a much bigger period of time. But there are periods where you got a bit of divergences, even in this type of relationship right here. Okay, and since we are at it, before moving on, let's check the good old metric that the Fed uses to assess the value of the DXY. I just don't remember the name. It was dollar trade weighted index, I guess. Basically, it's another representation of the relative strength of the dollar compared to other fiat currencies, but it's based on trades, right? Instead of, you know, being a very narrow down relationship like the DXY, which again, euro, Japanese yen, and whatnot. So we are noticing the same, right? Although on a weekly time frame, the DXY took out this weekly low, this one didn't yet. So we're still there on the macro picture. Nothing really changed. So it's still, in my view, at the very least, it's still a point against the continuing dollar doom and gloom and whatnot. So I would say for now, neutral, a little bit on the watch for a potential surprise to the upside. Otherwise, it's still the same grinding action and potentially choppy action. All right, nothing more to say on my end. Conversely, the other majors, they kept on, well, basically grinding to the upside, with again a little bit of a pullback on Friday. So the euro, the pound, the dollar Canadian actually performed a very nice breakout, consolidation, pullback, reaccumulation, breakout again, retest, up again. So dollar Canadian, it's not bad. It's moving particularly orderly in my view. What could be quote unquote alarming? It's the fact that over the last few months, basically beginning of April, you got the Swiss franc really going to the upside. So you know, kind of like the Japanese yen, this is seen by the market and the general financial literature as some sort of a safe haven trade. So could this be some sort of a early warning that maybe conditions are not so good as you might expect by looking at them on the surface? Maybe. And bear in mind, again, to get back to interest rates differential, the the Swiss central bank, again, they cut rates and they are, I guess, now below 1% against, again, the 4.5% you can get on a 10-year yield, or at least, Fed funds its what now. It's still in the, it should be 4.33 as for the median of the range that the Fed is targeting. But again, there is a huge differential if you just look at the rate. And nonetheless, the dollar, it's weakening a lot against the Swiss franc, right? So another thing to bear in mind if you don't want to be a victim of the narratives, all right? As for the other currencies, nothing major. I mean, the BRICS, I just moved the Australian dollar together with the BRICS just for the sake of it. I wanted to keep the Swiss franc there with the other majors. But other than that, I just replaced the Mexican peso, which was occupying this quadrant right here. But nothing major here, nothing to see. I guess it's still the same trend as before. So I wouldn't waste too much time on it. Now there is an interesting dynamic maybe at play on crude oil, and when was that? June the 2nd was, I guess it was Monday. Yeah, it was Monday right here. So I was just noticing that oil it stayed in this range. It tapped into the upper side of the range again, tried to get back to the low side. It didn't. It stopped right in the middle. So you could say the EQ of the range is now providing support. And at least when I looked at the positioning, I was noticing that, there were a lot of short positions. You can check these reports about the so-called CTAs, the computer trading algorithms, right? They are just based on momentum. So if the market goes up, they chase. If the market goes down, they chase to the downside. So they keep on selling as the market goes down, and they need to start buying if the momentum of the market shifts. So they were pretty much all short. And so I said, you know what, there is a huge amount of short interest which could be tapped in if we start to crack the 64 level. So it's going to be interesting, or it could be interesting to see what happens. We might get a short squeeze as price breaks through, and you got all these machines which now need to shift from the selling routine to the buying routine, right? And they don't really know, they don't care about the fundamentals. They are just based on momentum more often than not, which is why this could generate a bit of a short squeeze in my view. How much how violent it could be. If you look on the left, we could tap back into 66. But I guess if it is really a short squeeze, like a proper short squeeze, and if you look at what a spike in crude oil could be generally, like you get back into here or into here or into here. I know, it looks like there are not, you news which could drive the market so high. It would be just a matter of positioning this time around. While in the past we might have had a few shocks even on the news side. But nonetheless, I mean, would it be crazy to think if oil really starts to run, it could test back into the 68? I think it's not that far stretched. It might be, but at this point, I just want to see what's going to happen on Monday because we are right at the edge of this previous high, which is still, if you look at the entire structure, the swing which is in control of the overall downsloped type of momentum. I think again we kind of broke it already. So I'm getting ready for the possibility of oil spiking. Then again, if you see it immediately reversing and collapsing down on Monday and having a week of a straight downside play, then again, probably not gonna squeeze, but I'm getting ready for it nonetheless. I think you know uh, want to play the game. Okay, gun at my head, we're gonna have it. All right, how the magnitude of it again in between this range, in between 66 and 68. I think it could be violent, but yeah, just monitor it very closely because if it's gonna move fast, one way or the other. Either it's gonna be a huge failure, so a breakout attempt, and it fails, and it's gonna be driven immediately lower, or if it starts to run, I guess it could start to run very quickly, right? So let's move on to gold. Gold was interesting, right? Um, we've seen at the end of it what we were kind of forecasting 2 weeks ago. There was this consolidation right in here, and then potentially another breakout attempt and a retest of the highs. Uh, did we get it? Kinda, but also kinda no. I mean, we got pretty close, right, to the previous highs. If you look at them on a closing base, it could be much more evident if you do like this, right? So we kind of got back in that region, but then again, comes Thursday and especially Friday, we had an immediate pullback. Now, does it mean gold it's fucked? I again, I wouldn't think so right away. Our first point of potential bounce could be this point of release, while we do retest if you look at a former trend line, the breakout level, and even if we manage to get back below it, I think we still get a bit of support, at least initial support at this level. Now, this level might be tricky because if you look at how it came up, these series of higher lows I'm not particularly sure. I mean, it just shows you that there were many different pickups of liquidity to the downside. So either it immediately react at the upper side of the basin here. If it starts to crack it, uh, the liquidity below it was absorbed. So we might have a bit of a spiky spike a bit deeper into it. But again, one step after the other. Look at this level first. Then if this one fails, look below, and especially look how we go there, right? What type of delivery do we have? Okay, uh, the sharper the move, the the better the chances of a bounce initially, in my view. If we keep on drifting, at that point I might be a bit more on the watch for a potential failure. But overall, I think on a macro scale, if you're looking at it with a perspective of the next 4 weeks, 6 months, or whatever we are not yet at the point where I would start to be worried for gold to completely reverse. It is true, I'm not going to deny that if you zoom out really a lot, let's say you go on a monthly time frame, we are getting pretty much extended on gold. All right. So it's just natural. At a point, it's going to have its big pullback, and everyone will be scared if they're holding positions into gold. But I don't think it's gonna come next week. let's let's settle the topic that way. So look at this level, look at the lower one, and I guess again the potential for gold, as we were discussing in the past, of having something like this where it goes sideways for a few weeks, if not months, it's still on the bingo card, right? So my point of invalidation for the upside momentum, it still remains this one, the previous monthly low. This failure, of continuation and breakout of previous monthly highs could be a warning sign, maybe. But again, up until the point, we don't crack this region, I still maintain a neutral, slightly bullish bias on it. And then we'll see how it goes, and we will judge it level by level in the short term. All right. Let's move on to Bitcoin. Again, even Bitcoin was a bit of it. It traded basically as we were expecting, right? Um, and there was this moment. It was basically on Thursday and Friday, I guess, where it was looking like, okay, so we got back into here, another faded bounce. We were looking at the bulls, and we said they need to show up particularly quickly. They're a little bit on the clock. If we fail at this level right here, we might retest the lower side of the previous range. And lo and behold, we got back into that, and we immediately bounced. Now, again, is this just some sort of an automatic rally because we tapped back into previous demand? Or it is just because at the end of it, Bitcoin kind of followed what the rest of the market did? Look, whatever you want to put the quote unquote blame on, what really matters for you as a trader is that this level was here, it was good in the past, and it's been proven good this time around too. So that's it. At the end of it, it's just human behavior. We need to rationalize, we need to put a reason on everything. And sometimes, this is why you got technical analysis, I guess. Um, it just strip away a lot of prejudice, a lot of narratives, a lot of biases. It doesn't matter if it is just an horizontal level or a line in the sand right here, like in this case. They could be whatever. I'm sure I didn't check, but I'm sure if you check a different type of a layout, you might have some moving average right in this region, which magically held up price. I don't know. Maybe it was 55 exponential on the daily. Maybe it was what could it be? A 10 period simple moving average on the weekly. I don't know. Whatever, right? But uh, just rely more on the RTA rather than the narratives. And again, More often than not, if your TA is good enough or has been proven good enough over the months, chances are it's going to keep you safe more often than not. So just establish points of invalidation like we got in here, right? We tap back into this level after breaking out. If the bounce is faded and bulls don't show up, we might revisit the lower one. And we got that. And it looks like, at least for now, bulls showed up right at the lower one. Now, it's kind of tricky at the moment, I guess, because after a deeper peak up right here, in an area which was already tapped in 1, 2, 3 times, almost 4 with this spike, if this was a little bit of an anecdote for you. This is a behavior I often notice on the NQ futures on a much smaller time frame, right? It looks like it's gaining momentum, then it stops a bit, it gets back to an area where you didn't really expect it was revisited before the subsequent pump, but it ends up that was right the area you needed to buy. So the point is, at this point, at least in my view, I want to see it going. I want to see it going towards the high. If we got another failed bounce right here, at that point, I really think we might test lower at this point. So in the mid 90s, 96, 97, whatever. But up until the point again, we hold this point of invalidation for the very, very short term. To the as for your downside risk type of a line descent, you know, chances are either we keep on going sharply or we establish a new daily range in this region. But I really don't want to see it getting back to test this level once again. I would be particularly skeptical for another bounce if I see that. Then again, we'll see. Bitcoin can, I mean, the market in general, but it can always surprise you, right? Nobody really has the Bible here. We are just trying to assess probabilities. So let's move on to yields. Yields were again probably news driven, probably not, but it's just the natural ebb and flow of the market, I guess. So they were pulling back for over the last, I guess, 2 weeks, maybe end of May, right? The last week of May and then the beginning of June, and they just on a Thursday and Friday they got this massive spike. Look, there was, as you well know, a lot of different things happening, macro data coming in. There was this talk again in between President Trump and President Xi. So again, the trade war, it's now escalating. Oh no, after 2 days, now it's de-escalating. So it, it moves so fast that it's really hard to keep up the pace. But I think again, nothing is really changing. Um, they're not moving sharply. They're still operating in this sort of a grinding behavior. So it's like when you wait for the next earthquake at the San Antonio crack, right? You know that at a point there will be the big one, but up until the point it doesn't happen, all the rest it's just normal uh, geological activity. It's not the real big one. So it's kind of the same. Up until the point I don't really see a spike to the upside, which is sustained, I'm not gonna give up on seeing a race eventually getting back a bit lower in the coming months. All right. And look, do you remember we were always talking about rates being a reflection of inflation expectations and growth and whatnot? Um, what it's really funny for me, it's a little bit of another false narrative in my view. So two things. First of all, a huge component of inflation, at least again as measured by the CPI, it's housing or it's rent. All right. Now, it just seems to me, like, at least standing to a few researchers around, that in this case is Redfin, all right, that it looks like there are starting to be more sellers in the housing market rather than buyers. So the orange line, of course, are the sellers, the black line are the buyers, and the histogram in the background is the ratio in between sellers and buyers. And of course, if you have sellers at the numerator and buyers at the denominator, the more sellers you got, the more the ratio will go up, at least. Unless, again, my very poor skills in math actually failed me. But you get the gist of it by just looking at the chart, especially if you're much more math savvy than me. All right. And same, if you look at, why it is important. Well, because usually the year-over-year change in these ratio, it's a good signal for what eventually the price of the sector will do. Right. So that would be one thing. So not only that, as for housing in general, but if you keep on going, what you see is that if you look at the condos, right, the sellers in the condo segment of the housing market space, the sellers in that specific sector are even higher than what you could observe by looking at it generally, right? So it's still Redfin, and they are now estimating that in the condo sector, the difference between the number of sellers and buyers is now 83%. So there are 83.5% more sellers compared to buyers. And then again, that plays with, inflation numbers, and therefore sooner or later yields should reflect that new reality in inflation. So another thing about this inflation debate, and therefore, what yields gonna do compared to it, is this one. Now, I remember throughout the pandemic, everyone was screaming at the government data, saying, "Yeah, I mean, you know what? Yeah, it's true that the the establishment survey it's saying that inflation it's a 9%. If you zoom, you can't really. Okay, I'm not subscribed, but if you remember, inflation was it peaked out at 9%, and everyone was screaming, looking at this data, trueflation, saying, "Yeah, but actually, that survey is a lie. It's much higher than 9%. It might be a 10, 11. I don't remember what these data was back then, but anyway, the data by the establishment was severely uh, overestimated, or at least it was underestimating the current level of inflation because true inflation was higher than that. But now, right, that inflation is cooled off, and I guess the last read was what, 2.3, 2.4, and true inflation is giving you 1.19, not 91, whatever, 1.9 for the sake of rounding the numbers. So why nobody is screaming that now the establishment survey or data point is actually overestimating inflation? Because true inflation is giving you a result which is lower than 2.3 or 2.4. So therefore now the government it's telling you that you got more inflation than what you really have, rather than 2 or 3 years ago they were telling you you were suffering less inflation than what you were really suffering. How does it work? Are you looking at these only when it's a good fit for your thesis? So, are people just cherry picking the data at this point? But I mean, again, it's just, one tiny thing that sometimes gets to me. I just, at least once a week, I monitor this one just for the sake of it, right? But, anyway, as for the rates, I think again, we might get the continuation of this behavior and eventually really going nowhere. If you look at the bonds, as for the futures, if you remember, we were looking at this bounce opportunity 2 weeks ago. And last week I said, do I think bonds will keep on rallying from here? I don't know because I didn't know. And I specifically said, I just think that was the easy one. And so I took that long. But we started out this week by keeping on rallying. Okay. And I guess, as we are going to notice in a minute when we check the economic calendar, a lot of it was due to that ADP report, which came in particularly weak, right? So maybe, just maybe, the narrative was, okay, so the labor market, it's really starting to crack. But then at the end of it, we got NFP coming out above expectations, and the bond market immediately sold off. Equities rallied, gold sold off, Bitcoin bounced, and all the rest, right? Again, President Trump talking with President Xi. So, oh, okay, so the trade war, yeah, we are going to settle that one. Once again, we are not going to escalate that once again. So we are all cool, right? Uh, it's I'm not gonna be I'm not gonna tire myself of saying that it's a very much headline driven market, which is why you need to pay attention. And my favorite tool, yet, it's the financial juice app, right? So that was it for the initial part of the charts. We're gonna get back to it in a minute. I need to sort out a few slides that I wanted to go through just for the sake of it. And we're gonna look at what equities did. We're gonna check a bit of the data as for the labor market, and we'll see if they are really telling the truth or not. So let's have a look at the equity market. And as promised, let's start out by looking at a few data before. So, okay, by a simple perspective of gains and losses, the last 5 days for the S&P index saw it advancing 1.50%. And of course, if you just look at the XLK, so the technology sector, outperformed the overall benchmark. So naturally, what you're going to see in the charts is that NQ or the QQQ, all right, the Nasdaq in general is currently outperforming the S&P in general. So technology is leading the charge, which again, it's kind of cool when you look at it with throughout the lenses of a bull market. But let's look at the economic calendar. And I know I changed again the calendar up. I think I showed at least three for now in these videos: the MyFX book, the Forex Factory app. I used to rely on them a lot, especially when I started to trade traditional markets, because I mainly come from the FX market when I started out. But I found different one. I do like. I already told this story. I do like trading economics because sometimes throughout the day, if I need to check the calendar or specific data, it's much easier for me, instead of opening a few charts, or sorry, a few tabs, just grabbing my phone. I got a shortcut on the home screen, and the calendar app, it's very clean and intuitive. So I do like this one a lot. And as I said when we were looking 2 weeks ago at the labor market data, it's really complete, even for the type of data set that it provides for different metrics. But anyway, without having to you know, run through all the single lines of the economic calendar, I just isolated the tabs that we are interested in, right? So I hope they're going to be in a chronological order, but starting out with ISM manufacturing PMI, which came in, as you can see, at 48.5. So a bit of a decline. Uh, if you look at it from the beginning of the year, it's a diffusion index. So basically everything which is below 50, it's not particularly good, all right? But it's not really collapsing at the very least. But in my view, it's not the best sign you could wish for from the market. Then of course we got the services PMI. And even in here, it's strange because, again, starting October 2024, they are just collapsing. Uh, it doesn't really jive well with all the narrative of the economy, which is going to be bigger, better than ever before. But nonetheless, these are the data we have to work with. So then we start to get into the juicy stuff. We got the JOLTS opening number, which came in really, in my view, really bad. I mean, 7.4. Uh, in this case would be 7,400 jobs. In my view, it's not really cool at the end of it. and you can see even in here the down slope of the trend. So this is another thing with it's not really in favor of a very strong labor market. And we got was in my this was as I was saying before, what really drove, what was that, the bonds maybe, yeah, higher, the bad numbers in the ADP employment change. uh, Look, it came in at 37. Now you might think 37 it's a good number, right? If you didn't have the chart right here for the trend, you might say it's a good number. But we are talking about an economy which counts what, 350 million people. So I don't look at it as a good number, at least in my view. Everything we are going through, to me, is just testimony of a labor market which, again, as I said 2 weeks ago, it's not straight out collapsing, but it's getting softer and softer, right? Then we got the jobless claims. Well, they came in a war, 247. Uh, Over the last, I mean, the bottom, or at least the most recent bottom, was January. So starting January 2025, they just kept on ticking up. So again, my sort of a line in the sand with these would be, yeah, to three 300k mainly. So for now, we are still in that sort of a huge range. I remember that I said that the preliminary warning would be 260, 270k, but if these things start to crack 300k, then you really know we got a problem in the labor market, right? Then what we got was the non-farm payrolls, of course, which this was this is another thing. We might look at the charts for this one, but by looking at these, you just notice that they came in better than expected. But if you put them in relation with what happened throughout the last, I think this is a 3-year chart. Yeah, I mean, we're not really going anywhere, or at least we're not going to the upside. So again, another thing which doesn't really bode well for an economy which should be on fire. Then we go again, the labor force participation. Uh, Everyone looks at the headline and they don't put it into context with what's going on. So if you look at the participation rate after 2020, it got a bounce, and then it looks like we are rolling over. But we went over it 2 weeks ago when we looked at all the labor statistics. But still, just to reiterate the fact that maybe it's not all so rosy, right? And of course, the average hourly earnings, which came in, I guess, a bit better than expected, right? They came in at 3.9. The previous was 3.9, but it was forecasted at 3.7, so better than expected, or 20 basis points. It's not the end of the world. But again, even in here, you see the trend. There is another trend that if you look closely to all these data points, starting in here, the ISM PMI, when was the initial stage of this rally? October, November 2024. Okay. The services PMI, if you check, it was going up and up and up and up. You don't really see that. October, it just starts to go down, but this might be the outlier. Let's move ahead. Even in here, the JOLTS jobs opening, September, October, November, right? The last spike was around November, and then it started to get back down. If you look at the ADP employment change, it was going up until we got into October, November, and the NF, yeah, the non-farm payroll, they started to go up October, November, December, right? And eventually, that's all. But the trend, in my view, it's kind of like after the election, there was this kind of resurgence in this type of data set, right? People were hiring, sentiment was increasing, a few data points started to get better, uh, and then you start to see it immediately, and after in December, in January 2025, everything starts to roll over. So Maybe it was just the election type of euphoria because Trump was or at least promised to be very business oriented, business friendly. And now we started to see the tariffs coming in and all the rest. And the overall economy and the markets, they started to say, but maybe it's not all great as we expect, right? I, I guess it's pretty evident if you start to check NFPs, and although if you think that the headline was good, it might be sobering up to look at what the revisions have been over the last few months. And actually, getting back to 2023, for 2025 alone, when you account for the revisions, right, it looks like you're down more than 200,000 jobs compared to what the initial release was. So again, it's not that cool in my view overall at the end of it. And again, the same type of assessment could be done for the unemployment rate. When you adjust the unemployment rate for the participation rate, depending, I mean, where you lean, right? If you look at the glass half full or half empty, but if you start to make a few adjustments, these 4.2 as a headline on the surface, it could be that it's much closer to 5%. Because you need to remember that when people just stop to looking for a job, they basically fall out of the statistics as for the unemployment, right? But yet, nonetheless, you have someone which is not working, it's not getting a wage, and it's not consuming anymore. So, although the numbers are not picking him up, he is becoming now a drag, a negative component on the overall GDP equation, right? So, a few data points which are in contrast with each other. And ironically, the market at the end of it just focused on the NFP. Although, you see that NFP tends to be a very unreliable type of data set because it can be revised and it's been revised many different times. And don't worry, it's probably going to be revised this time around too. So, that's one thing for you. If you then look at it in a short term, then all of this doesn't really matter for you because we do know that the market, especially in the very short term, it moves off of the headline. So if you check the week, we got a very positive week starting out on Monday, straight up. Tuesday we got a little bit of a pullback throughout Asia and the European session. Comes the US session, up only, right? Then we transition into Wednesday, which was a bit of a consolidation day, nothing really huge. The market kept on staying in this type of a consolidating volatile environment. Thursday we started to get all the talks about Trump, Xi, conflicting data points coming in. Then we got the start of the Trump Elon type of argument over the social media. But I don't think the market was really looking at Elon Musk and Trump on social media, but it was just nervous in general, choppy and rangy. So we ended up Thursday having a little bit of, we completed that type of a Thursday reversal. We got a pullback on Thursday, but then again, the market started to recover early in the day as for Friday. And when NFP came in better than expected, the market just rallied. Here, I mean, if you just look at the 30 minutes time frame, you might say, okay, but you just said before while looking at the sectors, right? So basically this one right here, okay? You said that overall you like the fact that INQ is kind of leading the chart, right? But if we just focus on the close for the week, it looks like the S&P closed much stronger than NQ, right? And even the Dow, right? Okay, but just if you zoom out a little bit, I mean, overall, they are kind of moving together, NQ and ES. But, to me, it looks like NQ is much more mature in this attempt of breaking out of this consolidation, all right? So at the end of it, I keep on thinking NQ it's kind of leading the charge still. What's really lagging again, it's the Russell 2000. And bear in mind, the Russell 2000, it's really the expression of the US domestic economy. The left side of the chart, so the S&P and NQ, it's vastly influenced by the Mach 7. But the Mach 7, you know, 40% or maybe even more than that of the revenues come from abroad. So it's not necessarily a reflection of what's going on in the US. So always bear in mind that, small caps are a bit more of a type of a reliable read on the US domestic economy rather than the S&P. Okay, but nonetheless, at the end of it, if you just look at the technicals, this market, it's still particularly bullish. It's slowly grinding to the upside. We basically got back, we broke back in, this level, which was, it's evident in here and in here, right? It was support, it was broken to the downside, flipped as resistance, reapproached after the huge dump. New break to the upside this time, so now resistance becomes expected support. We retested it, confirmed as support because of the bounce. And now, I mean, realistically, your next resistance level is all-time highs at this point. There is really not a lot in the way. Even if you look at it from a moving average standpoint, this 200 days moving average is providing the support which was requested. The faster moving averages are confirming now a bullish trend, so very short-term momentum gaining right here. So, the yellow crossing above of the green, and the yellow, it's now, so the faster moving average, it's now providing support for the market while the market overall is above the 200 and the 100 days moving average. So, all cool. I mean, the stochastic, it's not going anywhere. So you might say, okay, we would like to see it turning back up and confirming the strength of this move to the upside. We are maybe in danger of creating a few divergences on the RSI, but yet we are not seeing them confirmed or actionable. The MACD, as we pointed out last week, it's on a sell signal right now. But yet, as I said, it could be, all right, it could be this one. It's one of those which is a bit mild type of signal, and it will result just in a choppy action and in a market which is consolidating but overall still grinding to the upside with no major pullbacks. All right. So just as for the MACD, maybe subdued type of returns or upside advances, but not really signaling a huge, you know, downturn crash potential, in my view. All right. Um, Another thing which would sustain the upside momentum is the fact that volatility, it's way below the 20s now, and it looks like it keeps on contracting. Again, at a point, we're going to see a spike in volatility just by the nature of these, because it's it's designed to contract and then expand. But up until the point you see volatility and the VIX coming down, there shouldn't be an immediate type of risk for the market. So now that we got the general picture for the market, which again, bullish oriented, bullish biased, bear in mind at a point we might get a correction, but it could be, could be in a month, could be in 2 months. You remember the statistics for the seasonality. And you remember June tend to be a little bit of a weaker month. The next week it's going to be the last one, and then we are going to see the corporate share buyback window closing down before of Q2 earnings season. So we might lose a very important buyer in the market. So does it mean the market is going to crash? Again, no, it might just be that we see a little bit more of a choppy action. But up until the point you don't really see a turnaround, I would maintain a general bullish outlook. And if we got maybe 1-2 days of a drop, right, so a pullback, you know, you should see them as opportunities to buy the dip. in my view, up until the point we are above the moving averages and the levels we were looking at before. Okay, so one thing which could be interesting, since we hinted at the seasonality, is that approaching June tends to be a weaker period of the year. So do we just, I mean, not we in general, but if you remember the old saying of Sally May go away, right? Is it really applicable? Now let's have a look at a few slides. So historically, it is true that June tends to be a lackluster month in terms of returns compared to the rest of the year, right? You got basically your very strong periods of the year, which basically go from uh, October, November up until January. And then you got from January to July, August, which is a little bit of a weaker period of the year. As for the S&P returns, on average, again, we are talking averages, just remember the market in the end, on a year by year base, it doesn't necessarily return you the averages, but over a long period of time, nonetheless, it's worth to look at them. Okay, so it is true that selling may go away. It kind of makes sense, right? Otherwise, it wouldn't be that cliche that everyone knows, right? So now here they are comparing some sort of a two type strategy, right? Sorry, two approaches, right? A strategy with two legs, which is basically holding period or, you know, being maxed out, so very heavily exposed to the stock market in the very good periods against the, selling may go away type of strategy where you want to be exposed to the market from November to April and then not being so exposed from May to October, right? And you see that it kind of makes sense. The selling may go away type of strategy, it returns you more. So again, it would make sense. But then you look at these and you contrast that with these other type of analysis, right? When I was a little bit victim of it too, right? I said, wait a minute, how can it be possible that if the data set is the same, the previous chart was telling you that selling may go away and actually guarantee you a much better compounded returns over a longer period of time. And instead, when you look at this study, it tells you that actually buy and hold, it returns you more. Now, I guess the real argument here relies in two things. One is that if you just check the dates, these get back in time to the 60s, basically, and these start in the 70s. So maybe already excluding or including a 10-year period, it could influence the end result. But I guess there are also the other fact that recently, in recent years, um, you know, May or June, they weren't particularly bad, especially if you remember 2023, right? So I guess it was 2023, right? Yeah, but even in 2024, the real scare for the market, it came in August with the carry trade. Yeah. So, anyway, in recent years, uh, the type of strategy didn't really work. But to really settle the argument, selling may go away. It makes more sense when you start to look at it from a risk adjusted type of a view. So, in terms of risk return, it makes more sense because if you check, although overall the buy and hold strategy could return you more, it exposes you to a much bigger volatility. If you check the standard deviation, right, you see that buy and hold has mainly double the amount of volatility of selling may go away. And even if you look at the Sharpe ratio, it's kind of double on the selling may go away. So if you just look at it in terms of, okay, if I want to maximize my returns, but keeping my risk and being exposed to the lower amount of volatility possible, selling may go away makes more sense. If instead you're looking at absolute returns, buy and hold make more sense. The problem is always the same. It's easy to look in hindsight to some sort of a data set like this and say, well, you know what, I'm just going to buy and hold. Yeah, okay, but what happens when then you find yourself in something like this, 20% correction? Would you again? It's easy to say now because the market it's just got back basically at all-time highs. But if you were max exposed in this drawdown and you never sold anything, I don't think you were sleeping very cool at night. You got that continuous thoughts creeping in your brain saying, what should I do? What should I do? What if it keeps on plunging? Maybe should I sell now? But what do I do? If I sell now, I'm down 20% on my portfolio. Does it make sense? I should have sold before. I should have de-risked, but now I can't really de-risk. So what do I do? Do I try to trim my positions down now? But what if the market turns around, as it often does, as soon as the market breaks my psychology and I become a forced seller, then the market will immediately reverse. So maybe should I hold? Should I not? Again, it's very easy to get victim of these sort of psychological traps and ending up making the worst possible choice at the worst possible time. So I think at the end of it, the selling May go away type of strategy can save you from these type of problems and preventing you from making very bad mistakes, even though overall it might grant you a little bit less returns than buy and hold. Because buy and hold, you can only do that if you really, want to do that. If you don't get caught in all these traps that the market will throw at you, the uncertainty, the geopolitical climate, right? The economy, the data, inflation, the tariffs, the trade war, right? So it works on paper, but it could be way more difficult than what you expect to do it when you find yourself in that in real time. So now the problem becomes, together with the buyback window, which is going to close, it looks that we are gonna have a bit of a slowdown in the earning growth. So first of all, when you look at this chart, it's kind of like when we were comparing the two strategies. You might have conflicting reports, analysts saying different things, and we're going to get to it at the end of the entire logic. But, you know, earnings at the end of the day, over the long period of time, they drive the price of the stock and therefore the overall index, right? So what's the problem with earnings right now? The problem is that if you look at a chart which it gets back to the 30s basically, and if you check the long-term trend of earnings, we are now pushing toward the high side of this channel, right? And every time it goes there, right, it doesn't stay there much longer, right? It tends to mean revert. So that plus the slide we were looking at before may signal that we are going to see some sort of a mean reversion in earnings and in potentially earnings forecasts and whatnot. In contrast, because we like to look at both sides of the coin, there are other sources that are now forecasting a little bit of a bottoming formation in earnings, especially for the Max 7, right? So, which one would you pick, right? Because depending who you listen to, that's going to change your behavior and your biases and your expectations. I would tend to go with this one, right? Not because it's a much longer data series, but also because I think, if you look at the market, uh, you know, look at it on a weekly time frame, we got a nice momentum in this market. So I think it wouldn't be unusual to see this market after, having this huge deviation to the downside, being brought back into the previous range, getting into the summer months with less activity, investors taking vacations, lighter volumes. I would lean more toward this type of environment right here. Does it mean it's going to come next week? Again, no. It might take another 2 or 3 months. We don't know. But I would lean toward this. Why it is important, right? It is important because, as we discussed in the past, the annual annual change in earnings is the best indicator when you compare it with the annual rate of change in the S&P 500. All right. But look, there is another thing which is tied to earnings and therefore the benchmark return, which is the, you know, what do you need to generate earnings? Do you need someone which is actually buying the stuff, the services, the widgets from the companies, and therefore allowing them to generate revenues? And that thing is consumption. So if you look, there is a good enough correlation in PCE, so personal consumption expenditures, and the S&P forward earnings year-over-year percentage change. Because you as a consumer, you buy stuff, therefore the company generates the revenue actually helps to boost up the earnings, and then the earnings leads to a price appreciation in the stock, in the underlying asset of the company, right? That makes sense. But what is driving consumption? I mean, this is just to highlight the correlation, which is not massive, right? And if you look at it, there are a good chunk of outliers, but yeah, nonetheless, it is not something I would score right away, right? Especially because the outliers are basically government interventions. So if you just assume that the government stayed the fuck out of the way of the economy, the normal trend for the economy would be reflected, by these concentration instead of these outliers right here, and you might get a much better R squared, right? But we were saying, what is driving consumption? It's confidence, right? There is again a nice correlation in between PCE and consumer confidence. So if you start to connect the dots, you might say that at the end of it, if you just try to simplify, consumer sentiment and confidence could drive earnings growth and therefore price appreciation, which is basically what you see, more or less. So this is why, although we might say consumer confidence sometimes it's just a result of political driven type of expectation, optimism and pessimism, it doesn't really matter if confidence it's based on very solid evidences, because up until a point it really changes the consumption habits and the spending habits of consumers. It can still be a drag down the line on the overall trend for the economy, for earnings, and therefore for the stock market in general. And here we circle back to the contrasting slides of the beginning. One which says we kind of reached a temporary peak in earnings growth, and the other saying, well, actually, we are at a bottom in earnings growth, especially for the Mach 7. This is it. I remember I was pointing out when we were talking about the millennial earning season where everyone gets a prize because earning projection are always revised lowered, so it's easier to beat them and to boost the returns and the price appreciation of the stocks, right? And when interviewed, a lot of analysts were saying, well, we don't really rely on the data. We were not particularly interested in providing data which are rooted in economic realities, but we just want the broker to be happy, the insiders to be happy, the employees to be happy, because a lot, especially the managers, because a lot of their compensation comes in the form of stocks, right? So it's kind of the same again when you look at earnings projection and you look at the surveys. It's again, when they, and this is for the CFOs, right? So when they are asked what is the most influential factors in cooking the books and therefore making your revenues or your earnings look better than what they really are, why are you doing that? Because let's assume that everyone is doing it. They are. Account gimmicks, whatever they are doing it. All right. So, and these are the reasons basically. You can just look at them and make up your mind, right? Inside pressure to hit earnings benchmark, senior managers fear for their career, right, influence the stock depending on the earnings, right? So the forecasts, sometimes they are inflated, at least by the internal CFOs, just you know, to obtain what they want, which at the end of it, it's a stock to go higher, right? So always bear in mind these dynamics and don't take, again, I guess at the end of it, the entire point of the video, it's not take things at face value. We've seen it with the NFP and the labor data for this week. We've seen it for the sell in May go away, and now we've seen it for the projected earnings and whatnot. Always pay attention. I know it sounds like a broken record, but always pay attention to the narrative. And always remember, narratives are set either to fail or, again, to be the catalyst for something which is supposed to happen or it already happened, and now you need to explain why it happened, right? And the bottom line is probably your TA, it's much more reliable than all these data points, mainstream media outlets and whatnot. And even, podcasts and commentator on the internet. And of course, the talking heads on CNBC, CNN, Bloomberg, and whatnot. Okay, so that was it for today and for this week. And now, since it's already 11. Well, I need to get back to my daily normal outside markets life if I want to be ready to get out of home after lunch. So, wishing you a very good rest of your Sunday at this point and a very good start of your week on Monday. And we're going to be back next week for another recap. But, until then, be nice and be cool as usual. Nils out.
Mm-hmm. 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 Come on. Mm-hmm. Mm-hmm.